Hey everybody, Blake Bunch here with Camarda Wealth Advisors. I want to bring you a special update on the K-1, K-3 questions that we've been receiving. This is for clients who have been a client of Camarda before January of 2023. And one of the things that we've talked about as an investment board is trying to limit or get rid of any K-1 tax forms that have to be reported to your tax CPA or for your tax filing. So this was for a position that was held into January of 2023 and sold out shortly after. And so if you were a client that came on board after January of 2023, you can disregard this notice. But please be advised that you may be receiving one more Schedule K-1 tax form related to your Camarda investment strategies during the 2023 tax year. Some ETFs are structured as a partnership, which are required to issue K-1s. And unlike most tax forms related to your investments, K-1s will be sent directly from the fund company itself and not from Camarda or Schwab or TD Ameritrade. Also, different from most other tax forms, K-1s are typically not due to shareholders until March 15th each year and can be at latest October 15th if they file an extension. We have learned that many of our clients have started receiving K-1s from fund company Invesco this week. So please watch your mailbox for these important forms to ensure they are included when completing your 2023 tax return. You will also receive a separate K-1 for each partnership ETF, or what's called a K-3 if it's a foreign partnership. And for any educational purposes you may wish to review, Invesco has an ETF K-1 tax center that can answer some of the frequently asked questions regarding these types of investments. If you have any questions regarding your specific situation, please contact your tax professional. Thank you for that, and here's Jonathan with a market update.
Greetings, Jonathan Camarda. Hopefully everyone's doing well as we roll into mid-March. So we'll kind of start with a top-down economically and then maneuver into the equities and fixed income markets. So last week, obviously, we saw jobs numbers coming in at 275,000. That was the gilded level. The surface underneath or behind the curtain, so to speak, not nearly as promising. So we're going to get to that. In fact, you could almost say it was overshadowed by last month's revision down from the blockbuster mid-300s down to the low 200s. Now, the 275,000, the lion's share were government jobs, federal, local, state jobs. We had a reduction in manufacturing and energy jobs, which are now starting to increase, as well as, you had technology and finance as well. Now, technology, which was the lion's share of last year's job losses, are reducing on a percentage basis, still there, as companies are cutting jobs at a very, very fast clip. Technological innovations, etc., are some of the reasons when you peel back the layers of what the rationale is. But here's the deal, folks. Job slashes by corporations are the largest since, all right, drum roll please, 2009. So we don't need to go back to that time period, but from that standpoint, that's 15 years. So while the top level looks attractive, these months keep getting revised back. Our fear here, okay, editorial moment, is that the Fed, like my father used to say, playing baseball, always look for the fastball and adjust to the change, because if you do the reverse, you're going to smell leather. And of course, the Fed lives smelling leather. They were slow on the uptake with raising rates, and we believe that they're going to be a little slow, as this month they were projected to, again, reduce rates. Now it looks like June and maybe beyond as we get close to election. However, we hope they're not, but we think that maybe getting sucked into this Pollyanna jobs numbers that are really not that promising. In fact, we saw unemployment rise, from that standpoint, and also participation rate reduce. So in these numbers, there's also caked in second and third jobs, okay? So just keep an eye on that. So from an economic standpoint, that's why we see bond yields, we see the yield curve dropping there, is we already think, which of course the yield curve has a PhD in all this stuff, already kind of sniffs that ahead of time. In confluence, we see gold rising to all-time highs beyond the 2011-2012 range it's been in recently. 2011-2012 was the last time it was this high, and it was in a recent range over the last couple of years trying to break out. It just has. Now, what does that mean, folks? Well, there's also obviously fears about fiat currencies on a global basis, but also, again, if rates are expected to dip, gold doesn't pay any yield, So therefore it becomes attractive to buy. And institutional buying, it's really not even been that heavy. We could see, some real movement to the upside in that forum. Now, in active capital preservation, we already have a small gold position there. And as such, couple with that as a balancer on the fixed income. But nonetheless, these are markets to watch. Now, on top of that, we have the U.S. dollar, which was somewhat resilient into the fourth quarter, early fourth quarter last year. February this year, after January kind of hanging in there, is being, is going down as well. Makes sense. Gold's going up, dollar's going down, yields are dropping. But the jobs number shows some economic resilience, which we think is a down feather pillow in its actual strength. Now, what does this mean for equities, fixed income, and as such? Bears well for fixed income as rates go down, right? Fixed income components of your strategies obviously doing pretty well. And then also equities, of course, have been doing very well as well with rates going down. A lot of different things that have been attractive, certainly technologies and semiconductors, which many of you have been enjoying as well to the upside. But have we overrun the course? That's the question. Again, the computers have been buying. Retail's been buying at every dip. When will that stop? Well, the market's been traveling in a range, still technically, looking at the charts, still pretty decently strong. The breadth, that is advancers versus decliners, still looks attractive from that standpoint until it isn't. And again, what's happened is the market, imagine traveling through a channel, imagine a hallway, and a ball just bouncing between the walls. Well, if it bounces through a door, in other words, on the downside through support, you will see those same computers that have been buying in the dip selling hard. So again, a correction may be in the cards as we move through the spring. And of course, we always have our foot near that brake pedal because all parties come to an end. However, fundamentally, there are a lot of reasons still to like stocks. And really, on a historic basis, when they look at overvaluations, not really, not even in the tech space. And certainly for those that go back to the 20, 30 year plus time periods, it's not even comparable. The market was a manufacturing market back then. It is an AI innovation market, services, not as much CapEx involved, which means investments in hard assets, which means the actual PE ratios really are apples to oranges. So you can't just look at that as well. All this means is we keep our hands on the wheel, foot next to the brake pedal. If you have any questions on your individual risk tolerance and how it relates to the models and then also the markets, certainly talk to your personal wealth advisors on that as well as I do my clients. And with that being said, stay frosty. Until next time, we'll talk to you.